If you've inherited an IRA or expect to give one, what I'm about to show you could save you and your family a fortune. In this video, I'm going to walk you through what an inherited IRA is, which beneficiaries fall into different classification types, 3 mistakes that cost families consistently the most money, and a tax strategy that can offset taxable income in many cases if you are currently working. We will cover why the 2020 Secure Act changed everything for inheritances, and I'll give you a step-by-step framework you can research and implement for your benefit. My name's Bob Wolfe. I'm a certified financial planner and an IRS enrolled agent. It's important to note this content is strictly educational in nature and should not be misconstrued as specific investment, tax, or legal advice. So with that being said, let's jump right into it. So what is an inherited IRA and why did 2020 change everything? Before 2020, most could stretch their distributions from their inherited IRA over their remaining lifetime. Now, the rules depend entirely on what type of beneficiary they are, and most people do not have an idea of which category they fall into. Get this wrong, and you could lose decades of tax-deferred growth and have penalties to pay on top of it. So, let's cover the 3 types of beneficiaries. So, category number 1 are the lucky ones, and they're termed as eligible designated beneficiaries. These are the people who get the most flexibility. If you're in this category, you won the inheritance lottery. Congratulations. And these people include surviving spouses. This is the most common eligible designated beneficiary. If you inherit your spouse's IRA, you have incredible flexibility. You can actually treat that inherited IRA as your own, which means you can make contributions to it, delay distributions until your own required beginning date, and essentially reset the clock. It's like getting a do-over on retirement planning entirely. But here's what most spouses don't necessarily realize. You have a choice. You can either treat it as your own IRA or keep it as an inherited IRA. If you are younger than 59 and a half and might need the money, keeping it as an inherited IRA could let you withdraw without the 10% early withdrawal penalty. This flexibility may be worth its weight in gold depending on your situation. Next up are minor children, but only until they reach the age of majority. Once they turn 18, they get bumped into this 10-year rule we'll talk about more. The clock starts ticking at their 21st birthday. Next up, of eligible designated beneficiaries, we have individuals with chronic illness or disabilities. They can stretch distributions over their life expectancy, but there are strict medical requirements to qualify. Next, we have beneficiaries within 10 years of the deceased age. This could be a sibling or a close friend. If you're not more than 10 years younger than the person who passed, you get the stretch option. Age becomes your superpower here. So the next category is non-eligible designated beneficiaries, and this is where a lot of people fall into. This is where most adult children, grandchildren, nieces, nephews end up. If you're in this category, you're subject to the harsh 10-year rule. This is where the government gets most of their tax revenue increased from the Secure Act. This is a 10-year countdown. You must completely empty the inherited IRA by December 31st of the 10th year following the year of passing. So if somebody died on March 2024, you have until December 31st, 2034 to distribute it entirely. Note that the 10-year clock runs continuously, even the RMD waivers from 2021 to 2024, which basically gave people time while the government was figuring out how to implement all of these new laws. That still would count towards that 10-year timeline, depending on if we inherited an account during that time period. Now, here's where things start to get even trickier. There are actually 2 different versions of the 10-year rule that most people don't know about. The first version is if the person who passed had not started taking their required minimum distributions yet. You have complete flexibility during those 10 years. You can take nothing out for 9 years, and then you can empty it all in year 10, or spread it evenly, or take it all in year 1. You control the timing, and the considerations will be different if you're inheriting a traditional account or a Roth account often. Now, the second version is if the person who passed had already started taking required minimum distributions. You must continue taking annual RMDs during the 10 years and still empty the account by the end of year 10. You get the worst of both worlds. You're forced to take annual distributions plus the 10-year deadline. The third category is non-designated beneficiaries. These entities are in the worst position. These are beneficiaries that are not individuals, like estates if we didn't name anyone as a beneficiary, charities, or trusts that usually don't meet specific requirements. They get the harshest treatment. If the deceased had not started taking distributions yet, their required distributions, the account must be emptied by December 31st of the 5th year following death. If the deceased had already started taking distributions and RMDs, the distributions must continue over the decedent's remaining life expectancy while still satisfying that 5-year requirement. Now let's take a look at a specific scenario that has two very different outcomes for individuals that are inheriting the same amount. Let's take two friends of somebody who are inheriting identical IRAs from the same individual. They could face completely different consequences based on their ages. It's like a genetic lottery for taxes. Let me give you the scenario. Let's say a 70-year-old passes away and leaves identical $500,000 gifts to their friends. Their first friend is 66 years old and their second friend is 55 years old. The same inheritance, completely different tax outcomes. The first friend is within 10 years of their age, so they are an eligible designated beneficiary. They can stretch distributions over their remaining life expectancy, potentially 20 or more years of tax-deferred growth. The second friend is a non-eligible designated beneficiary, which they're stuck with the 10-year rule. They must empty the entire account within 10 years, same inheritance, but the second friend gets financially punished for being younger. So now that we understand the beneficiary types, what we're looking at with new legislation, let me talk to you about some mistakes that will be costing families money, starting with a sample couple, Bob and Sue. This is a composite of scenarios that I've analyzed by working through this legislation. They inherited a $1 million IRA and made the first catastrophic mistake. What happened next will probably shock you. Mistake number one, the lump sum disaster. They thought, let's just cash this out and buy our dream home. Seems simple, right? That simple decision cost them $325,000 in the year that they took the distribution. They turned a $1 million inheritance into a $675,000 inheritance with one phone call. Here's what happened. Taking the $1 million in 1 year pushed them into the highest tax brackets quickly. They got hit with the higher federal taxes, higher state taxes, and their Medicare premiums skyrocketed. It was a tax avalanche. But here's the kicker. If they had spread that same $1 million over a 10-year period, their total bill would have been just $240,000. They literally threw away $85,000 because they didn't understand the rules. $85,000 that could have stayed in their family forever with compound interest. Second mistake, being mistake number two, would be the setup trap. So the second mistake is not setting up the account properly. If you don't roll the inherited funds into a properly titled inherited IRA, you lose critical tax benefits. This is not optional. The IRS requires special handling, and if you mess this up, you cannot fix it later. The third mistake is revolving procrastination, and it's waiting until the last minute to figure out what we're going to be doing with this account. There will be plenty of people who wait until year 9 or 10, then suddenly realize they have to withdraw the entire balance all at once. That can create a big tax bomb for inherited accounts that are traditional in nature that could have been completely avoided. Now that we've gone over the tough stuff, let's go over some of the strategies that we can use to offset and get in front of these challenges. And first off, we're going to be going and looking at a strategy that can help offset the tax impact for individuals that are still working. Most people think that they have to just accept paying taxes on the inherited IRA withdrawals. But what if I told you that there's a way to withdraw money, satisfy the IRS requirements, and potentially offset much of the taxable income? It's completely legal, it's not fancy, but depends on your specific situation. Here's the strategy. I call it the tax offset method, and it only works if you're currently working and have access to a 401k, 403b, 457, or a similar retirement account. This strategy can offset taxable income in many cases, subject to contribution limits and other thresholds. Here's how it works. Step number one, take systematic withdrawals from the traditional inherited IRA, let's say $10,000 a year. The IRS is happy because you're taking money out and paying taxes on it along the way. Step number 2, simultaneously increase your retirement plan pre-tax contributions by the exact same amount, $10,000 per year up to the annual contribution limits. You are putting the same money right back into retirement savings. The strategy, the inherited IRA withdrawal increases your taxable income by $10,000, but the increased retirement contribution decreases your taxable income by $10,000 in this example. When executed properly within the contribution limits, it can create a complete or large offset of this income. This strategy essentially can help you transfer your inherited IRA into your own retirement account with minimal additional tax impact while maintaining investment growth potential. Now we can talk about 3 additional strategies that take a little bit more complexity to consider, but are a little bit more advanced and can also help with this tax challenge. The first strategy being income timing and taking larger distributions in years where your income is lower. Maybe the year you retire, take a sabbatical, or have a job transition. Your tax bracket becomes your best friend. Strategy number 2, tax bracket management. Carefully calculating distributions to stay just under the next tax bracket threshold. This requires annual planning and precise planning, but can save thousands over time. Every dollar matters when you're managing 6 to 7 figure inheritances. Strategy number 3, Medicare premium optimization for higher income increases. And these surcharges, the IRMA surcharges, are based on a 2-year look back of your modified adjusted gross income. So timing matters significantly here. Strategic distribution timing can help you avoid these premium spikes. Medicare premiums can add thousands to your tax bill if you're not careful. Strategy number 4, and the last being, consider shifting more safe investments like bonds from a Roth account or a non-retirement account to an inherited traditional account or any inherited account. This is something that's called tax location, and it might mean lower growth for the traditional account, but also lower taxes to be paid when the account is inevitably withdrawn, leaving higher potential growth assets in the more tax-advantaged accounts that may be Roth or non-retirement accounts that's subject for a favorable capital gains tax treatment. All right, so now that we've gone over a little bit of what we need to know, how we can get in front of it, we need to talk about what you absolutely cannot do. And these are the rules that you cannot break. Otherwise, you'll face significant penalties that will make any tax bill look small. First, you cannot make contributions to an inherited IRA ever. It is not your retirement account, unless you are a spouse and you roll it over into yours. Next, non-spouse beneficiaries cannot convert inherited IRAs to Roth IRAs. Those spouses who treat the account as their own can convert later. Next, non-spouses cannot do indirect rollovers. Only direct transfers between one custodian and another. This is a rollover. Be very careful. If you touch the money, you are taxed on it. Next, you cannot ignore the 10-year deadline if you are a non-eligible designated beneficiary, or a 5-year deadline if you are the third bracket. If you do not take distributions that you otherwise have to, the penalty actually dropped from 50% down to 25%, but this is more of an onerous penalty that we need to avoid if we possibly can. 25% on any unpaid RMD is a pain. All right, now that we went over some of that, we need to consider what can we immediately do if we've inherited an IRA, and I mean immediately, not next month. The first step I would recommend is finding a qualified tax professional or advisor who specializes and knows the inherited IRA rules. Not all advisors and accountants understand these rules. Generic advice, WebMD or Financial Life can cost you thousands. Step number 2, create a comprehensive distribution plan that considers your entire financial situation, including current income, other investments, healthcare considerations and costs. This is not a one-size-fits-all solution. Step number 3, set up the inherited IRA properly with the considerations surrounding what we would like to do with it, with the right custodian, and ensure that it's titled properly. Get the paperwork wrong and you can't fix it later. This pays to measure thrice before we cut the check. Step number 4, implement systematic distributions based on your tax strategy. Consistency here beats perfection in tax planning. So now that we've gone over this, let's talk about some key takeaways and an action plan. The 3 most important things to remember here, and we'll want to write these down because they could save you or your family thousands. The first being, know which type of beneficiary you are or who will be receiving these. This determines everything about the distribution options and optimal strategy. Your classification is your financial destiny. Second, if you're working and stuck with the 10-year rule, the tax offset strategy could help reduce your additional tax burden, subject to contribution limits and other thresholds. It's like getting significant tax relief on your inheritance while following the rules. The third being professional guidance isn't really optional here, in my opinion. The tax stakes are too high and the rules are too complex to navigate alone. The cost of good advice here is nothing compared to the cost of the onerous mistakes if handled improperly. So if you've inherited an IRA, expect to inherit one, or expect to give one, and want a bite-sized checklist and flowcharts that I put together to help you navigate this wicked web of inherited accounts, see the link in the description and on the screen to help understand what lies ahead, how to get in front of it, and seek additional guidance for how it may be applied and leveraged to increase your after-tax wealth. And if this video opens your eyes to inherited IRA strategies or considerations you never knew existed, share it with someone else who might be facing same decisions or considerations. Your share could help them avoid catastrophic mistakes that can cost families tens or even hundreds of thousands of dollars over time. Thanks for tuning into our video today on the wicked web of inherited IRA taxes, and I'll see you in the next video where we'll uncover some more financial strategies to help make sure that you keep more of your dollars in your pocket.